30 compared to the short straddle. Comparatively view is market might win slightly bigger wider range compared to the short straddle, because in short straddle you are selling same strike call and put usually at the money, but in short strangle you are selling out of the money calls and puts. So the benefit is you are getting the wider range. Again, benefit of time decay, more the OTM puts and calls, decay will be fast, premium income. Disadvantage, you are getting the lesser premium benefit. Risk is unlimited like the short straddle also. This is strategy when you are expecting sideways but slightly higher. Now look at this example. Market is near to 12,200. You are selling 12,200 call and 11,800 put. So 200 points out of the money calls and put you are selling. So in this you are getting net 20 plus 60, 80 points. Your upper side strike is 12,200, 12,200 plus 80, 12,280. Your lower side strike is 11,800 minus 80, so that goes to 11,720. So if market moves in between 11,720 to 12,280, you are going to make money. But if it moves beyond this boundary, your risk is unlimited. Look at this payoff. You are at profit till it remains in between 11,720 to 12,280. Your maximum profit if it remains in between 11,800 to 12,200 zone, and your unlimited risk if it goes below 11,720 or above 12,280. So look at the different scenario. If it goes to 11,600, that is 120 points lower than your break even, so you are at 120 points loss. Look at 12,400, that is your 120 points higher than your break even, so you are at 120 point loss. So without going into the individual strike, you can directly calculate from your break even. In short strangle and short straddle, you are having two break even, upper break even and the lower break even. So look at the live example of the short strangle in the markets. Let's say we are at 11,650 and I am selling 250 points higher calls and put. So if I look at the 250 points higher, I'll sell 11,900 call at 45 and 11,400 put at 67. So 11,650, I'm taking 250 points lower, 250 points higher. So 11,400 and 11,900 call and 11,400 put. So if I look at the premium of 11,900 call, again that is near to 45 rupees. If you look at the 11,400 put premium, that is near to 67 rupees. So if you look at the net to net, we are getting 112 rupees. So right now we are at 11,650. We sold 250 points higher strike, that is 11,900, and 250 points lower strike, that is 11,400. You must remember here that put premium is higher than the call premium. That always remain in our market most of the time, because there is more panic into the put compared to the call because of the volatility and the market scenario. So IVE and the premium of put remains higher compared to the premium of the calls. And again, when market is slightly negative trend, your put premium always remains higher compared to the call premium. Now look at your payoff graph diagram. If market remains in between 11,400 to 11,900, you are getting the premium benefit of 112 points. This is your break even. Your break even will be 11,900 plus 112. Your lower break even will be 11,400 minus 112. So that is 11,288 on the lower side. Your upper side it will be 11,900 plus 112, so that is 12,012. That is your upper break even. So till market remains in between this range, you will be in profit. But if it moves out of this range, you are at loss. So if you do the comparative analysis of short strangle and short straddle, you'll notice in short straddle you are getting more premium, but risk is also higher. In short strangle you are getting less premium, but risk is also lesser comparatively. In short straddle you are getting the range, but in strangle you are getting the bigger range. Now look at this neutral strategy, the iron butterfly.
Register for our free webinar. Download our app today. Link in description.